Okay, thanks so much, everybody, for joining us today. Appreciate everybody taking the time out of their days to join us on our Wednesday webinar here at K Properties and Investments. My name is Dwight K. I am the founder and CEO of K Properties and Investments. We appreciate each one of you for joining us. Many of our clients, long-term clients, are on the webinar today, and thank you for your business over the years. There's actually literally thousands of you that have invested through a 1031 exchange and the DSTs with K Properties and the 721 exchange UPREIT strategy with K Properties. Thousands of you over the last nearly 2 decades. I can't believe it. Time flies. And we just really appreciate you. Thank you for allowing us to serve you, allowing us to give you advice and guidance regarding your situation. So thank you for our current clients on the line here. For those of you that are new to us, I'll get into a little bit about who we are and what we do, how we serve our clients, and we'll start out the webinar today. So today we're talking about, excuse me, and also full disclosure, I have a bit of a cough right now, so excuse me for that along the way. But starting out here, we're talking about the anchor and buoy strategy. It's a strategy that we found to work very well, very complementary for investors that are considering a 1031 into DSTs, as well as investors that are considering a DST that's going to be a 721 exchange UPREIT strategy. The anchor and buoy is something that we kind of coined that can work well for investors. So we'll just jump into it here. So starting out, risks and disclosures. We always are big on walking through with our investors, not just the potential pros of a 1031 exchange and DSTs and 721 exchange UPREITs, but also the potential cons and what the risk factors are. So obviously, if you're on this call, you've likely already spoken to one of our team members, and we've kind of dug into that a little bit. But DSTs, just briefly here, and 721 UPREITs, they're investments in real estate. And real estate, as you know, owning properties in your own towns and cities and across the country, real estate has no guarantees that tenants will pay rent, no guarantees that buildings will go up in value. There are risks in real estate. And so we encourage investors, read the private placement memorandum. That's the legal document on any one of the Delaware Statutory Trusts or the 721 exchange UPREITs that you may consider. And it goes through the business plan of the offering as well as the potential risk factors. So we encourage clients to read it. Along with that, the 1031, the 1033, the 721, they're complex tax concepts. So we're not CPAs or attorneys, although we have CPAs and attorneys on staff here at K Properties. We're not providing tax or legal advice to our investors. We encourage you to talk to your own CPA and attorney for advice regarding your situation, tax and legal for your situation. If you need to, if your CPA or attorney, which this happens a lot, they might not be as well versed in the DST or the 1031 or the 1033 or the 721 UPREIT as our accountants, CPAs, and attorneys that we have on staff. And so we're happy to set up a call where they can kind of walk through the implications with your CPA and attorney, and they speak the same language and are able to help them get up to speed quickly. So we're happy to do that and make that as a resource to our clients. And that's a pretty big resource in our opinion, and it's been very helpful to many clients. So, but we can't provide tax and legal advice to you. Next, diversification does not guarantee profits or guarantee protection against losses. So we are big on the anchor and the buoy. That's a diversified approach, but it never guarantees that you're always going to make money or you'll never lose money. But that's why we employ the diversification concept to excuse me, to protect investors in as prudent of a fashion as possible. And we can only do that through a diversified approach. Others out there, they want to tell you that this is the best DST or this is the best UPREIT, and they have their clients invest their entire 10 or 20 million dollars into one offering, one UPREIT or one DST. We think that's a very big mistake. We've seen investors come to us that have done that through others, and they really wish they hadn't. So diversification is something that we're big on, and we're going to talk about it today. Next, past performance is not indicative of future returns. Potential cash flows, returns, and appreciation are not guaranteed and could be lower than anticipated. quickly on K Properties, we're specialized in 1031 exchange, Delaware Statutory Trust. I wrote the first book on Delaware Statutory Trust back before most people that, most of the sponsors in this space, they started over the last 5 years or so. This was nearly, excuse me, long time ago that this book was written, and I had a chapter in it on the 721 exchange UPREIT. So before most of the sponsors in the space were in the space, I wrote the first book because there wasn't really a lot of educational material for my clients that were considering 1031s, DSTs, and 721s, nearly 2 decades ago. So I started writing articles published in various real estate journals, and from there compiled them and authored and published my first book on the subject matter. And that's been a really helpful thing for our investors over the years. So we're proud to say, specialization, one of the very first, doing these DSTs at scale, and helping investors like yourself. Thousands of clients, over 2,200 clients nationwide, have done over, I think it's closer to 10,000 DST, 1031, and 721 UPREIT investments with us since we started nearly 2 decades ago. So lots and lots of clients that we've helped. We're a little different at K Properties. We're not sponsoring a deal. You're not investing in a K Properties deal. We do have a sister company that's a sponsor company, Cove Capital, and I'm sure you'll see those available. But at K Properties, we work with our clients and show you what's available in the marketplace, right? From all the sponsors. A lot of groups, they only have contracts with 2 or 3 different sponsors, and so they only show you those 2 or 3 sponsors. The problem is that's really not a lot of options when you're considering real estate investments, right? And so at K Properties, we work with over 25 different sponsor companies, groups like Pasco, Inland, Cove Capital, our sister company, Invesco, Apollo, Starwood, okay, Blue Rock, Capital Square, just to name a few. These are groups that we essentially have been doing business with and bringing investors to for the last, excuse me, I'm getting a noted here. What is this? Okay, sorry about that. Just 1 second. Okay. So these are groups that, sorry about that, technical difficulties. These are groups that are sponsor companies. They put together the Delaware Statutory Trust offerings. They put together the 721 exchange UPREIT offerings, and then they bring them to us. And we're going to do our due diligence, our homework, and we're going to put them through our filters and decide which ones make sense for certain types of clients. And so when you log into the KPI1031.com member site, which if you don't have a password yet, or an account set up, please reach out to us, book a call, or just call our number. A team member will help you out there. But you'll be able to see all those offerings, okay? Not every single one of them is right for, each investor in their situation. Some clients want, leverage DSTs for their 1031 exchange. They have to take on debt in their 1031. We have those from these sponsors. Other clients want debt-free DSTs. They don't want to take on the risk of debt. We have those. Some clients want a traditional DST where they're able to 1031 exchange into another property, maybe a DST or maybe a property that they would own. When that DST goes full cycle or sells, we have those. Some clients want the 721 exchange UPREIT structure. We have those. So over 25 companies, we're going to show you, we're going to listen to your goals and objectives, what you're looking for, and then we're going to say, out of everything that we have available on the marketplace, these 6 different sponsor companies have offerings that make sense for what you're looking for, and we'll walk you through them, the potential pros and cons. And also don't forget, I've invested for since I think 2008 was the first time I invested in a DST. Personally, my wife and I've been doing this, as an investor just like you for a very long time, since 2008. I own personally over, I believe it's 100 DSTs now that I've invested in via 1031 exchange as well as cash investments. And these are through many of the sponsors in the space. ones that have been doing this for a very long time, ones that started, 3, 4, 5 years ago. Personal investment. So I have personal experience that is going to be passed down to you, our investors at K Properties. Okay, so that's a bit about us. So the 1031 exchange, briefly, tax deferred exchange under IRS section 1031 allows investors to sell a property and reinvest proceeds in a similar property. Summary of the rules, okay, very quick. Day one, you sell your property. Proceeds are escrowed with the qualified intermediary. We're not a qualified intermediary at K Properties. We think it's best to keep that separate. We never touch your proceeds. Other groups out there, they're doing it all. They're a qualified intermediary and they're trying to advise you as to what DSTs you should invest in. We think that's a flawed model. And so if you need a qualified intermediary, we will refer you. We work with many of the large national qualified intermediaries as well as some smaller qualified intermediaries that have done a really good job for our clients. So we can refer that out to you, but the proceeds are escrowed. From there, you have 45 days to identify your property. Okay, you've got to notify your qualified intermediary what you're going to purchase. Okay, and then from there, you need to close on those new properties, those new DSTs within 180 days after the first sale. Okay, that's number 3. Number 4, maintain equal or greater amount of equity. So if you sell for $5 million, you've got to buy for $5 million. You can't just pocket, a couple million and take on a loan. No, you got to reinvest all the net proceeds from the sale, the equity proceeds. And then number 5, maintain an equal or greater amount of debt. Okay, so if you sell for $5 million and you have a $2 million loan that gets paid off at the sale, you can't just reinvest that $3 million into, a DST. You've got to match the total purchase price. So if you sell for $5 million, you got to buy for $5 million. 2 strategies real quick that we've worked with clients. Some clients, they say, okay, I want to match my debt. And so we're looking at properties that are, 50, 60% loan to value, long-term fixed rate financing on the properties. 10 years is really what we like to see. So we'll have those on the marketplace at K Properties from various sponsors, walk you through the loans, kind of how they look like, what, things to be aware of in those. And you can replace that $5 million sale price with that. Other clients may say, I don't want to take on debt. They're totally liquid in other accounts. And so they take the $3 million from the sale, invest in a DSTs, and then they'll take $2 million of cash from other sources and invest in DSTs as well. Boom, you just completed equal or greater value. You reinvested $5 million, but you protected yourself. You didn't take on the risk of leverage. And we can walk you through those, reasons why in depth as we talk on the phone or we do Zooms or as you come to our office, our headquarters here, which a lot of our clients like to do, to see us, to meet us, to talk to the team. We're working with our clients for years and years and years. One of my very first clients, the team was down at his house, and it's nearly 20 years later, and we're still working with them, helping clients, helping their heirs. This is a long-term relationship for us at K Properties. So we can walk you through those details. But DSTs, why do investors like DSTs in general? It's a compelling blend of convenience, risk mitigation, and diversification, making them attractive. So you've got 1, elimination of the day-to-day headaches of property management. So no more tenants, toilets, and trash. 2, you've got portfolio diversification by geography and property types. So instead of one $5 million building in New York City or Miami or Dallas or LA, or one $5 million ranch in Wyoming, whatever it is, we've done thousands of these exchanges with clients. So people selling everything, all types of real estate, you name it, from as long as it's held for investment or business purposes, they're selling that real estate in one location typically, or they might have a portfolio of 50 single family homes in, North Carolina or Texas or Florida or LA, and they're concentrated in one area, and they're concerned about natural disasters or, rent control laws or, just that concentration risk. And so the DST allows you to sell that asset or that portfolio of assets and go into all different asset classes. So multifamily, industrial, small bay industrial, bulk distribution facilities, self-storage facilities, medical facilities, you name it, a bunch of different asset classes. So diversification there. and then also in a bunch of different geographic locations, okay? And then on top of that, with K Properties, you're not investing with just one sponsor, one management company, right? When you invest in a REIT or I'm sorry, ETF or a mutual fund, you're not just choosing one company, one management team, and hoping that they're going to do really well for you and for your investment dollars. You're doing a broad-based, diversified ETF or mutual fund that's got hundreds, a lot of times thousands of managers, you know, so that if one underperforms, maybe another one doesn't, right? And obviously, again, diversification doesn't guarantee profits or protect against losses, but it's the prudent thing to do. Where at K Properties, that's why we have 25 different sponsor companies or managers that you can choose from. So you're getting diversification there too, as opposed to the flawed model of trying to find, you know, one manager you like and betting the farm, so to say. A lot of our clients do sell farms and ranches, but betting that whole amount of capital on one property, on one manager, on one UPREIT 721 strategy, you get diversification. That's really important. That's how I personally do it and how we advise our clients. Long-term non-recourse financing locked in place on the DSTs, which is really nice. Access to high quality real estate. A lot of times these offerings are buildings that are 10, 20, 50, $100 million buildings that are out of the reach of a lot of our clients. Lots of our clients are investing anywhere from, you know, $500 to $1 million up to, you know, 10, 15 million. We've had the clients investing 50, 75, 100 million in that broad-based diversified DST and 721 UPREIT solution. So we work with those larger clients, but a lot of our, even the large clients, you know, a lot of the apartments and buildings that we work with, they're $50, $100 million buildings. So they would have to over concentrate into one of those buildings, where through this strategy, you can take a broad-based diversified approach. Next, DSTs typically are closing within 3 to 5 business days. So they're already locked in place, they're closed. You don't have the 1031 exchange risk of going out and finding your own property, offering on a property, getting an accepted LOI or letter of intent, negotiating the purchase and sale agreement with you know, with the seller, then digging into all your diligence, ordering your third-party reports, appraisal, environmental, property condition report, inspection, going out and seeing the property. If you have financing, all the financing situation with your bank or the lender, that's a real pain. Where these DSTs that you see on our platform, that's already been done by the sponsor. You get to review all that material and make sure you feel comfortable with it, read it, ask questions. We'll walk you through pros and cons of each deal, but it's all done. So once you decide on a DST, I mean, we've closed clients in as quickly as 24 hours where they've finished their 1031 exchange. So it's a prepackaged solution. So the anchor and buoy. So what is an anchor DST? An anchor DST is an investment that has a lower degree of potential variability in monthly distribution performance, like a long-term net lease property with a single corporate-backed tenant. It might be, you know, FedEx or an Amazon or a Pepsi distribution facility, or a Tractor Supplier or Walgreens. These are long-term corporate-backed leases with some of the largest companies in the world. And for instance, you know, sometimes, you know, one of these companies, their stock might take a hit and their stock value may go down. That doesn't truly affect us because they still have billions of dollars often in net income. It's just Wall Street, for whatever reason, is punishing the stock. We're landlords. We're senior in the capital stack and have priority, our rents, over dividends to the stock investors, right? That's why we call it an anchor, okay? It provides a lower degree of potential variability in monthly distributions and potentially more stability during times of uncertainty, economic turmoil, recessions, and pandemics, et cetera. One of the things that we were going through back in 21 and 22 is, you know, we're big on these types of anchors, right? I've seen them perform for nearly 2 decades very well for our investors, right? When you have a FedEx or a Pepsi or a Frito-Lay lease or a Tractor Supply, where all through the great financial crisis, you know, 08, 9, 10, 11, 12, that recession, well, they clipped their coupons, they paid their rent. And then fast forward through the coronavirus, 2020, they clipped their coupons, they paid their rent, they were deemed essential businesses, right? And then from, you know, so that was something that we saw, okay, wow, that's a really, for our investors that want a predictable, durable income stream, these are things to consider for them. Now, do you just go all into one FedEx or one of these buildings? No, you build a diversified portfolio. One of the things that happened though in 21 and 22, everybody in the industry, in their great wisdom to investors, said, don't ever buy a net lease. These essential businesses, you're never going to have any appreciation and you're never going to keep up with inflation. Okay. Well, we still were big on it. Yes, we allocate to multifamily and small bay industrial, other asset classes that have the ability to raise rents to keep up with inflation. But the phenomenon is that multifamily in 23 and 24, with the interest rate spikes that we saw, with the rising rates and the inflation that hit our country and our economy, all the costs of maintenance, insurance, taxes. I mean, insurance on a lot of commercial buildings, apartments included, doubled and tripled in many markets. As a landlord, and that's what you are as a DST owner, you own that real estate. As the landlord, you're responsible. You're the owner of the building, right? The asset manager, the sponsor company is managing it for you. But when insurance triples, and nobody thought it could triple on an apartment building, or property taxes go up, or maintenance costs, maintenance, labor, costs of goods to keep up that apartment building, as those skyrocketed from inflation, you have a gross lease with apartments. And so, yeah, you can raise your rents, but if rents are not being, rent growth slowed down, but expenses took off. And that way, those multifamily investments, a lot of them had to lower cash flows because you're an owner of the apartment building. Cash flows had to drop. And we've seen that with many sponsors across the board. It's not the sponsors bad, it's not the DST bad, it's just that real estate, that's how it works. And where with the anchor investments, all those increases, if property taxes go up, Pepsi's on the hook for that. If maintenance costs go up, FedEx is on the hook for that. If the insurance costs go up, Tractor Supply is on the hook for that, okay? The triple net leases actually did incredibly well during inflationary times. So the exact opposite of what all the gurus were saying came to pass. And that's, again, why we don't encourage investors to choose the asset class that is, the one in favor, the flavor of the day, the soup du jour. Oh, just do apartments, or just do this, or just do self-storage. You can't invest that way, folks. That's not the way to do it. That's not how I do it personally. You've got to get that broad-based diversification, and you have the anchor and the buoy. So the anchors these are the anchors. That's a little bit of reason why we're big on anchors. So an example anchor could be a Frito-Lay distribution facility. Through our sponsor company, Cove Capital, we've got, it's a sister company of K Properties. They're all debt-free properties. So if you have to replace debt, those likely won't work for you. We'll walk you through. That's why at K Properties, we don't just show you one or two deals. We don't just show you the Cove deals. We show you all the sponsor deals. We've been told by many of the largest sponsors in the DST space that K Properties raises more capital than anybody else for them and their program. And that's because we're more about, our team is fixated and focused on our investors, what they're looking for, what their goals, what their objectives are, not about selling any one particular product, okay? So we have the Cove Capital team. We've got, about $1 billion of debt-free assets under management, been wildly successful over there, putting together offerings that, I'm personally investing in each one of them. But the market has really resonated with what we're doing there. And we own, 10 or 12 Frito-Lay, Pepsi distribution facilities, 15 or 20 FedEx distribution facilities, Amazon, medical with large Fortune 500 companies as the tenants, but we do them debt free. So that's an example right here. This Frito-Lay distribution facility, 2% annual rent bumps, 2 5-year renewal options, purpose built for Frito-Lay, developed specifically for the tenant who uses a facility as a distribution facility. One of the ones that we just bought, we have 107 buildings in that Cove Capital portfolio. I was out at one of the buildings in North Carolina, just outside of Charlotte, talking with the facility managers. We're touring the asset, brand new buildings. He's so happy with the building, so great for his team. His last facility they were in. He was there for 21 years. He said that the company was in it for 30 years, and this one was purpose built for them to expand. And the delivery drivers love it because it's climate controlled, where the other one, when it was cold in North Carolina, they were freezing. When it was hot, they were sweating. They tend to stay a long time. No guarantees. These tenants can move out. They can, leave at the end of their lease, and you have to backfill the space and put a new tenant in there, and that takes some time, and there's no rent being paid during that time. But when you have that long-term, predictable, durable income stream from that tenant, a very large, one of the largest tenants in the world, that was deemed an essential business, that did well through the financial crisis in terms of the landlords getting paid rent, we feel really good about that. And then we also do it debt-free, right? There's certain deals that are single-tenant properties like this that have a loan on them. And that can work for certain clients, but you have to understand, if the tenant were to leave and your loan comes due, and you haven't backfilled the space, you'd probably lose the building to foreclosure. Just look at the news. I mean, many of the largest real estate companies in the world are giving back the keys on buildings to lenders, and that's across the board, not just office, but multifamily, self-storage, hospitality especially. The keys are going back to lenders, and equity is getting wiped out by the smartest and brightest minds of real estate in the world. That's why I've said, you know what, hey, I'm not the smartest and brightest. Okay, I didn't go to Wharton, right? But I've been through some stuff. I've been through the great financial crisis. I've been through coronavirus. The debt-free stuff with the largest tenants in the world paying the rent every month, that did really well for me personally. That's what I like to share with my clients, okay? So anyways, that's an example. Next, FedEx Ground, debt-free DST, long-term lease. That's one of them. The Walgreens, again, Walgreens stock has been taking a hit, but if you've got a building where, and there's a lot of stuff that we like to see, where the tenant has shown strong commitment to the location, they've been there for 10 or 15 years, and they just signed a brand new 15-year lease. It means they're making money at that location, and it all goes back to real estate is location, location, location. So the stock may go up and down, but if you've got a fundamentally, large company with, massive sales, massive revenue, massive net income, we're landlords, we're not the stock owners, okay? Pepsi deal, 100% occupied, PepsiCo, North America Beverages, long-term triple net lease, $79 billion in net revenue in 2021. These are tenants paying us rent each and every month. Okay, next. And so forgive me if I'm going quickly, I want to be respectful of everybody's time here, but what is a Buoy DST investment? So an investment that has potential for more variability in terms of occupancy, rental income, and corresponding growth. Okay, so the Buoy DST asset type examples are multifamily apartments, self-storage, multi-tenant industrial, small bay industrial, and multi-tenant retail. You have a diversified tenant base with the opportunity to raise rents, extend leases, and grow your net operating income, or NOI. And that's an effort to potentially increase your property value and investor equity. Again, this is what we were saying. Everybody wanted apartments to grow the rents and keep up with inflation and have big upside. And now, as the economic market has shifted, the apartments, the expenses are up and cash flows are down. Doesn't mean they're bad. Doesn't mean that the sponsor that did that deal is bad. It's just that that's how the economy works. It ebbs and flows. And that's why we encourage an anchor and a Buoy strategy in a diversified approach, right? So multifamily, self-storage, multi-tenant industrial, multi-tenant retail, those are considered Buoys. You may have variability in your income stream, okay? Just because the sponsor is projecting X percent per year, that this offering or property is going to produce, doesn't mean it will be that exactly. It could go up and down, but if you can hold through the market cycle, over time, likely, and obviously past performance doesn't guarantee future results, over time, you will hopefully see a rising of your rents, right? Manage expenses, and that equals an increased net operating income, which when you cap that out, you're looking at potential for property value and equity increase, okay? So an example, Buoy multifamily DST investment, it's the Houston multifamily DST, long-term fixed rate financing, moderate leverage, 38.4%, 10-year loan from Fannie Mae, 98% occupied, 2020 construction, Class A 50-unit building, top of the line amenities. And this building is in the Montrose area of Houston, very hip, trendy, arguably one of the best areas in Houston, with all, you know, the bars, the restaurants, the art galleries, you know, kind of the action, the cultural, you know, epicenter for that part of Houston. Really, really well located, very walkable. So that would be an example of a Buoy DST. The next is a multi-tenant flex DST, or small bay industrial. You've got significant income potential. You've got 99% occupied, Texas location. A lot of the tenants, recent tenant lease extensions and renewals, showing again strong commitment to the location. Thousands of homes being built around this property in particular. All cash debt-free offering. This one is sold out. It's just an example. We have other ones that are very similar, small bay industrial. We really like them because the small bay industrial compared to the bulk distribution warehouses, the bulk distribution is really great off of interstates, et cetera, and we own a lot of it, long-term leases with these large companies as a buoy. We really like that, I'm sorry, as an anchor. But the small bay industrial, we really like them for a handful of reasons. A, they're right there in the path of growth, very infill location with a lot going on around them. A lot of businesses, a lot of homes being built oftentimes in these high growth markets. And the tenants, the small bay industrial, these are servicing those communities. So the tenants, you pull from a wide array of tenants in small bay industrial, things like HVAC contractors, landscaping contractors, plumbing contractors. You've got all the dance studios, the MMA gyms, the CrossFit studios. You've got pickleball courts in some of these things. You've got, you know, nail salons. You can pull from a traditional retail user, nail salons, restaurants, coffee shops, you know, e-commerce businesses, 3D printing business, auto detailing businesses, auto wrap businesses. You've got just a wide array of tenants that are using these spaces. And it's the backbone of America, is that small business. So when you're pulling from, you know, the small businesses, you've got a lot of churches that are in these spaces. So if you look at general industrial, I don't remember the exact stats, but in general, industrial's done very well. Vacancy nationwide, I think, is around, you know, 7, 8, 9%. Okay, so a very healthy industrial market, a lot of absorption. But if you look at the small bay industrial, the vacancy is at, you know, 1 to 3%, right? So in a lot of these markets, so very, very tight markets, and that's because these types of assets aren't built. They didn't go through that development boom that the bulk distribution warehouses did. They just didn't, and so there hasn't been as much of it built. There's a lot of demand from tenants, like I was saying, a wide array of tenants. I left out, you know, half the different types of users, but you're in a situation where, you know, you've also got triple net leases on these, and so as, you know, the maintenance goes up and the cost for insurance goes up, and you know, all those items, you're really in a good spot because you're able to pass that through to these tenants, these users of these small bays. And the small bay, excuse me, small bay asset class, it's typically a 50,000 or 20 to 50,000 square foot asset. Okay, and the bays are anywhere from 1,000 to 5,000 square feet, sometimes up to 10, 12,000, but smaller spaces, wide array of small businesses that are in there. The downtime also, that's something really, really unique. To backfill a bulk distribution facility that's 300,000 square feet, if that tenant leaves, you're gonna have some downtime. You're gonna have, you know, some your rental income stream is gonna be impacted in a big way for at least 12 months, in our opinion. With the small bay industrial, the downtime is 1 to 3 months oftentimes for a lot of these spaces because they're in such high demand. There's not a lot of it. They're right there in the communities, all the homes being built. And then on top of it, we really like them because you're pulling, so not only those small bay users, but you can pull from traditional office users as well as from traditional retail users. And let me explain that a little bit. When you're looking at a small bay asset, you know, the rents at a small bay asset oftentimes are 50% below what an office building would be, 50%. And that actually happened to us at K Properties. We were renting in an office tower here in Los Angeles. We're in Torrance, the South Bay, near the airport. And, you know, we had, I don't know, 5 or 6 different suites, you know, in this building. And rent was getting very expensive. And we started thinking, well, let's look around, let's see what's available. We ended up finding a small bay industrial park right here by the Torrance Courthouse. Beautiful construction, really nice, new, clean. And the rents were, you know, 1/3 to 50% lower than the office space. And then we started looking at it, saying, wow, we could actually, you know, purchase one of these buildings, do a full gut rehab, get our teams in there, you know, and build out our space. And so that's what we did. My partner and I, we purchased the building, completely gutted it, renovated it. It's beautiful. It's now our headquarters building, and you'll see it when you come and visit us. But you know, you're pulling from traditional office users at Small Bay as well, people that want to cut down on their operating costs, right? And then also traditional retail users, right? So you go to a retail center, a nail salon, you know, you're $20 a foot, depending on the market. Where you can go to a Small Bay and you can be at $12 a foot, right? Almost half the cost. And so you're really pulling from a wide array of tenancy in the Small Bay asset class. But the neat thing is that a lot of these Small Bay deals that we're looking at, the rents are at or below market, right? And so over time, and the leases are shorter. We call them WALTs, weighted average lease terms, WALTs. They're oftentimes, you know, 1 to 3 years, 1 to 4 years. And so as those leases renew, you're getting in there. We've done this many times, and extending the leases at a higher rent potentially on those tenants. That's growing your net operating income. So the Small Bay asset class, we really like it right now for all those reasons. You've got triple net leases to protect you as the landlord or the DST investor from increases in inflationary costs to insurance, maintenance, et cetera. You've got very low CapEx when you're turning spaces. So that's really nice as well. It's not like office where you've got heavy TIs, or a bulk distribution, 300,000 square foot facility where you will have heavy TIs to backfill a space. Oftentimes, you know, you're just getting it ready for the new tenant and they're going right in. And then you've also got shorter lease terms at oftentimes below market rents. So you're able to increase that NOI. So I really like the Small Bay asset class right now. We consider it a buoy investment, you know, because you're able to potentially grow those rents, but it's got some protection built in, similar to an anchor investment. So, but again, you don't want to fixate on one particular, you know, strategy and just go all in on that, right? We really encourage a diversified approach. Next is a multifamily DST, 100% occupied. It's in Clarksville, Tennessee. This was the first debt-free multifamily DST in the history of DSTs. It was one of our first deals at Cove Capital. You know, Cove Capital, we built Cove Capital because why? Traditionally, the DST space, you know, 9.5 out of 10 deals, right? Or 95% of deals were leveraged. They always had debt. A lot of our clients are going, we don't want debt. We want to lower our risk. We don't want to have the risk of being foreclosed on. And sometimes some of the sponsors in our space would bring out a debt-free deal, but maybe once a year or twice a year. And at K Properties, we're working with a lot of 1031 investors and really trying to custom tailor to what they're looking for. And so because there wasn't a consistent source of debt-free product, we decided to build it ourselves. Fast forward, we have $1 billion under management. Cove Capital has nearly 2,000 investors. So really a successful strategy. This was, again, the first debt-free multifamily in the DST space. One of our first offerings at Cove Capital. The neat thing is we've changed the space. A lot of the sponsors now, because of the success that we've had at Cove, they're creating debt-free offerings, and we're able to show those to you now. So you can also get that diversified approach, not just going with one sponsor. And that's, again, what I was talking about at K Properties. Multi-tenant retail investment. Oftentimes these multi-tenant retail deals, they're opportunistic. You're buying them below replacement cost. You can buy them, you know, well-located centers, strong tenancy. We like doing them debt-free, you know, so that if there is an issue with one of the tenants, you're not stuck there, with that debt service each and every month that will potentially impact distributions to investors. So that's nice. You've got a value add strategy with these Buoy type multi-tenant retails. This was one in Birmingham, right next to a Walmart, right next to a brand new Amazon distribution facility. Really nice center. We've also got technology that we subscribe to that essentially pings the cell phones of visitors to these centers, and it'll let us know how many visits, per month and per year are at the location. How healthy is this location? Something the acquisition and asset management teams are looking at. This one was the #1 retail center in the market with 3.4 million visits annually. Again, this is an example, it's sold out, but 3.4 million visits annually. So, and then we look at the Walmart and, they're committed to their space and we're right next door. So we really like that asset class at the right basis, the right price point. So what are the pros and cons to consider of an anchor investment? First, predictable income stream potential, right? You've got that long-term lease agreement with a potentially reliable tenant base. These are some of the largest companies in the world, deemed essential businesses, did well through the recession of 2008 and 9, pandemic resistant. So there's minimal moving parts, that predictable, durable income stream from these tenants paying rent each and every month on a 5, 10, 15, 20-year lease, okay? You've got protection from inflationary cost increases due to the tenants being responsible for the majority of, if not all, maintenance, taxes, and insurance at the property level. So those are the pros. We like those, right? Well, what are the cons? Okay, there's always a pro and con that you have to weigh and understand. One, limited value add opportunities. The rent's the rent for 10 years with FedEx. You're not going to increase the rent and increase the NOI on your tenant, okay? You've got little to no tenant diversification, right? You've got one tenant in one building, which is, again, why the diversified strategy and the DST works really well there. You've got less flexibility in raising the rents. You've got lower upside and appreciation opportunity because you're not growing that NOI. But then in a time of compressing cap rates, upside can potentially be meaningful. I mean, I saw this back during the recession. Everybody was saying, again, oh, don't do net leases. You're not going to make any money. You won't keep up with inflation. This is 08 and 09. And even before that, right? Kind of 07 era, before the recession hit. Do the apartments, do the hotels, and then you can grow rents and grow your NOI and make money in real estate. It's easy. Well, no, it's not easy. And you've got, in a recessionary environment, rents drop, okay? Rents drop. And in a recessionary environment or a pandemic, people stop traveling for business, right? Or people stop traveling for leisure in a recession. So hotels really get hit hard. Or in a terror attack like 9/11, hospitality and the hotel business, hotel real estate really was impacted. Occupancy dropped, RevPAR dropped, NOI dropped for owners. You really have to be careful with those asset classes. And then, and they said, oh, you'll never make money. So, well, what happened? My clients that did these long-term triple net deals, these essential businesses, they clipped their coupon all through the recession. When the apartments and the hotels were dropping cash flow, right? Because of the recession, those long-term leases with those companies, they kept getting their rents each and every month. And then guess what happened? There was a flight to quality. 2010, 11, 12, everybody goes, oh my gosh, all these hotels, these apartments have suffered so much and rents have been dropping. What works well in real estate? Long-term net leases with some of the largest companies in the world. There was a flight to quality, cap rates compressed, okay? That was the exit for our investors that went into those properties back in, prior to the Great Recession. Cap rates compressed and they made a lot of money. So yes, you have lower upside and appreciation opportunity with an anchor DST. I have seen many times where anchor DSTs have actually made more money appreciation wise than apartments and other, operating type Buoy assets, okay? Again, no way to predict the future. Anybody that tries to tell you how to predict the future in investing in real estate or DSTs or UPREITs, run as fast as you can. There is no way, and that's why you have to have a well thought out thesis. What makes sense? What's worked in the past? How do we protect ourselves if it goes the other way? And that's through that diversified approach, understanding it is really important, really, really important. We bring that value to our investors. So all real estate and DST investments can go down in value. Distributions are never guaranteed in real estate and DST investments. That's true for an anchor or a buoy investment. Buoy DST investments, pros and cons to consider. Pros, you have a diversified tenant base. Instead of one tenant, maybe it's FedEx or Amazon, you've got 200 units in an apartment building, so 200 tenants, or 100 units in a self-storage building, or 25 tenants in a small bay industrial building, right? So that's nice. You've got a diversified tenant base. You've got potential for value add opportunities. You can get in there, redo, resurface the parking lot, redo the gutter and the downspouts, the roofing systems, HVAC, spruce up the building, the landscaping. You've got opportunities for painting the building and just adding, making it nicer for tenants and for people that are visiting their businesses or those properties. Those are value add opportunities. And that's going to give you the ability to adjust the rental rates, the lease rates, hopefully raise those rents, right? You've got a potential hedge against inflation. As inflation picks up, hopefully you're able to increase the rents on your tenants. Now there's a breaking point, right? If inflation gets so bad and the economy gets so bad, you're not going to be able to pass that on to tenants, right? And we saw that with a lot of the apartments during this last couple of years here, as I explained earlier. You've got a potential hedge against inflation. You've got potential to increase net operating income. Believe me, in apartments, ones that I've personally invested in and owned, as well as the Cove portfolio, and then also all the sponsors that I've invested with on the K platform. We've had a lot of growth in the apartment sector. We've made a lot of money, and that's because we hit the market right. But there's no guarantee that's going to happen again. But you potentially have a greater upside and appreciation potential with the buoy investment. No guarantees though, okay? Read the PPM, understand the risks. What are the cons? Shorter term leases, right? Instead of a 15-year FedEx lease, you've got a 1 month self-storage contract. It's not even a lease, it's a contract. Or a 12-month apartment lease, or a 1, 2, 3 year industrial lease on a small bay, right? So shorter term leases, that's a con. You've got greater variability in revenue and net operating income, or NOI, and that creates a potential for distribution volatility, okay? So that does exist, and that's why when you're looking at an approach for a 721 UPREIT solution or a DST solution or a combination of the two, which we often do, you really want to use that anchor and buoy, because there's just no way to know what the economy is going to do, how it's going to affect any asset. So you build that blended portfolio. And that's what we found works really well for our clients and for ourselves as we're investing. So you've got that variability and the potential for distribution volatility. Say you do a blended approach and the economy goes to hell in a handbasket, apartment rents are dropping, inflation's going up. You're really happy that you had a 15-year lease with FedEx. They're keep paying the rent. Maybe on the apartment DST, they had to lower the distributions by 10 or 15% or 20%, for example. But the FedEx DST, as long as they're not out of business, right, they're going to be paying that rent each and every month. And so it creates that anchor and buoy approach. So again, cons, gross leases, landlord responsible for maintenance, taxes, and insurance, and any increases from inflationary pressure. That is a con in everything but the small bay industrial. If the small bay industrial has triple net leases, right, you're able to pass that on through to the tenants. So that's a con of apartments and self-storage and other assets like that, is you've got gross leases. So any increases in those expenses will hit your bottom line. You got more moving parts and management intensive. So that's a consideration, and that's the reason why we work with some of these very large sponsors and groups that have full real estate capabilities to manage these assets. Very important. And then again, a con, all real estate and DST investments, as well as 721 UPREITs, can go down in value. Distributions are never guaranteed in real estate and DST investments. So utilizing the anchor and buoy strategy example portfolio, this is $1 million. Again, your exchange may be lower or higher. We can customize this for you, but you've got a net lease distribution DST. So a brand new construction, Pepsi Industrial Net Lease Distribution Warehouse, 100% occupied by PepsiCo under a long-term lease. It's debt-free. You put $250,000 of equity in there. That's an anchor. Next, you've got a pharmacy net lease. There's a Walgreens pharmacy, 15-year, strong commitment to the location, corporate backed. This could be also a FedEx distribution facility or an Amazon with that 10 or 15-year lease, right? This is just an example. 250,000 there, debt-free. That's an anchor. Next, Dallas multifamily, 159-unit value-add garden-style multifamily community in the Dallas-Fort Worth MSA. $250,000 there. It's debt-free. Then again, if you're leveraged, we have these solutions, same solutions with loans on them. So we can get you that, 30, 40, 50, 60% loan to value in your debt replacement. So for instance, if you put 250,000 into a DST that has a 50% loan to value, you just bought $500,000 worth of that offering. And we'll explain that further as give you illustrations on it. But that would be a Buoy, the Dallas multifamily DST. And then Eastwood Village, that's that Birmingham, Alabama multi-tenant retail center, the value add center, 3.4 million annual visits, 130,000 square feet, 250,000 there. That's multi-tenant retail, it's debt free, and that's another Buoy. So your $1 million is using the anchor and the Buoy strategy. So you've got the 10-year net lease DST. This is the same thing I just showed you. You've got the 10-year FedEx DST. You've got the 15-year Walgreens DST. You've got the multifamily apartment building DST in Dallas as a Buoy. And then you've got the multi-tenant retail DST in Birmingham as a Buoy as well. So 2 anchors, 2 buoys. We can get even more diversified and have 3, 4, 5, 6 anchors and 3, 4, 5, 6 buoys, depending on your preferences, but and then also depending on your amount of equity, right? Our clients that have 50 million plus in equity, we're not doing just 4 different offerings. We're building a diversified portfolio for them. And then same for clients that have 500 grand. We'll do 5 DSTs for that client, right? So a lot of times groups out there are trying to choose the best DST and to put all your money in this DST or because they're the best sponsor, put all your money in this 721 UPREIT strategy because they're the best and the biggest. That is a flawed model. I've seen it fail over and over and over again. You need to build a diversified portfolio. Again, it doesn't guarantee profits or protection from losses, but it is the prudent thing to do. That's how you invest. If you're going into the market, you don't choose one stock unless you're a highly sophisticated professional trader. If you're investing your retirement money, you're going in a broad-based blended ETF mutual fund portfolio with hundreds and hundreds, oftentimes thousands of stocks. That's what we do here. So we kind of went over this already. People do these 1031 DSTs and 721 UPREITs so they don't have to manage anymore. No more tenants, toilets, and trash. Professional asset and property management in place allows you as an investor to concentrate further on what really matters to you, your kids, grandkids, travel, careers, other businesses, and you enjoy life without the burden of actively managing your apartments, commercial properties, or any other type of property. So this is pretty much the conclusion here. Visit kpi1031.com. We're going to get you free access, set you up with an account with a password to our marketplace of DSTs. Typically over 25 DST sponsor companies. Again, we're working with these large institutional sponsors that are putting together these DSTs, 25 of them, and then talking to you about your goals and objectives. These 5 offerings from these 5 different sponsors make the most sense for you. Here's the pros, the cons, the risk factors, and we build you an illustration, help you understand what would make the most sense for you. And we can mix and match, right? We go through many iterations of these portfolios for you until you're satisfied and feel good about what you're doing. Our menu of options includes debt-free and leveraged DSTs. It includes 721 exchange UPREIT opportunities. There's, I think, 4 or 5 721 exchange UPREIT opportunities on our platform right now. Very important to understand what you're getting into with the 721 UPREIT strategy. There's situations that I'm looking at personally when I'm considering investing these that we're going to pass through to you, so that you can understand the pros and the cons with the different groups out there. They're all good companies, you know. None of these people that are putting together these offerings, in our opinion, are bad companies or evil people. They just have all different deals, and you have to know how to understand them and have to know how to look at them with a critical eye, do your due diligence, do your homework, and then build that diversified portfolio so that if something doesn't work out, you don't go to yourself, geez, honey, I wish we hadn't put the $20 million into that 1721 exchange UPREIT or those 2 different DSTs. You're going to wish you hadn't, right? We want that broad-based diversification. So register at the KPI1031.com marketplace. You're going to be able to get access, see the different offerings, book a call with us. We'll walk you through your options, kind of give you some of this insight. And then also, lastly, K Investor Day is coming up in April. Again, we have thousands of clients, many of them flying in to K Investor Day. We're going to have 5 or 6 of the sponsors that do the DSTs as well as the 721 exchange UPREITs at K Investor Day, walking through their strategies, what they do when they look at a piece of property, how their programs work, their overview, their track record, what they've done in the past. Obviously, past performance doesn't guarantee future results, but K Investor Day is going to have, it's going to be here in Southern California, right near our headquarters building. If you're considering a 1031 exchange for any sizable amount of money, I mean, even if it's, you know, 200-300 grand and you're local, come on out. I mean, we're going to have plenty of clients, I'm sure, that fly out with smaller amounts. But also, if you're considering, you know, that $1 million, $2 million, $5 million, 10, 20, $50 million exchange, K Investor Day, you're absolutely going to want to be at to interact and dialogue with these sponsor companies and hear their strategies. Okay, you'll get to see our team, meet with us. It's going to be a really great day. A lot of educational materials if you're considering, you know, and resources through this whole day, jam-packed really with, you know, ways to educate yourself on, does this strategy even make sense for you, right? And that's another thing we do at K, is that we have such a high amount of clients, and we've been doing this for so long. If a client comes to us and what we offer doesn't fit with what they're saying they need, we'll let them know. We'll let you know, this doesn't make sense for you. Here's why, you know, best of luck to you, but we're going to let you know. And that's something I think is a lot different than, you know, some of the other groups out there. But come to K Investor Day, you'll get the invitation soon. We'd love to have you. A lot of resources for you. You're going to learn a lot. And again, you know, get a copy of our book, the book I wrote, DST Digest magazine on DSTs and 721s, as well as our menu. Just log in at KPI 1031. And with that, thank you so much, everybody, for joining us. Our team is here to assist you any way possible. We are your resource for DSTs, 1031s, 721 exchange UPREITs. Give us a call. And also, I'm available personally for Zooms and in-person meetings with our clients. I do that all the time. As you have questions, you know, our team here at K Properties, you know, really nobody's done more of these types of transactions than the team. But then on top of that, I'm available as a resource. So you're going to have your team that you'll be assigned questions, getting your resources, getting your offerings, setting up your account, and they're going to be, you know, very focused in helping you, educate you along the way. But I'm also available as a resource to talk through your situation. So, you know, in person, you know, lunch or dinner, as well as Zooms, I'm available. So thank you so much, everybody. We really appreciate it, and enjoy the rest of your day.